This video is for educational purposes only and is not financial advice. I am not a financial advisor. Investing involves risk, including loss of capital. Any tools or strategies mentioned do not guarantee profits or future results.
Most investors are focused on the same handful of stocks. Big tech dominates headlines, portfolios, and most of the money flowing into the market. But what if that trend is about to reverse? According to Larry Benedict, a major shift called Project 2026 could move billions of dollars away from the biggest tech companies and into the rest of the market. And if that happens, it could completely reshape how money flows across the S&P 500. Now, that sounds like a bold claim, so let's break it down properly. Because the real opportunity here is not just one stock, it's a structural shift. Larry Benedict is a former hedge fund manager who built his strategy around one core idea. Instead of tracking dozens of stocks, focus on one high-impact opportunity tied to a major market event. That's the foundation of his service called One Ticker Trader. Now, his current thesis revolves around policy changes. The argument is simple. If government policies begin favouring domestic industries, capital could start rotating away from mega-cap tech stocks, often called the Magnificent Seven, and into hundreds of other companies that have been largely ignored. And that creates a very different market dynamic. Because for years, most of the gains in the S&P 500 have been driven by just a few large companies. If that concentration breaks, the rest of the market could finally start catching up. Benedict calls this group the Forgotten 493. And his strategy to play this shift is interesting. Instead of picking individual stocks, he focuses on an ETF called the Invesco S&P 500 Equal Weight ETF, which gives equal importance to all companies in the index. So if money flows into the broader market, this type of ETF could benefit more than traditional index funds. But here's where his approach becomes different. He's not just buying and holding. He uses options trading to take advantage of short-term volatility as this shift unfolds. That means instead of waiting years for returns, the goal is to capture multiple opportunities as the market reacts to policy changes. Now let's talk about what you actually get if you follow this strategy. Inside One Ticker Trader, members receive monthly research explaining the setup, along with trade alerts that include exact entry and exit points. There's also a beginner-friendly options trading guide, which is important because options can be complex if you're new to them. And everything revolves around a single ticker at a time, which keeps the strategy simple compared to managing a large portfolio. Now, let's address credibility. Larry Benedict has a strong background. He reportedly ran a hedge fund for years and delivered consistent returns, even being featured in well-known trading publications. But as always, past performance does not guarantee future results. And that's especially important here, because this entire strategy depends on one key assumption: that a policy-driven shift will actually move capital away from big tech and into the broader market. If that happens, the opportunity could be significant. If it doesn't, the strategy may not play out as expected. There's also another factor to consider. Options trading increases both potential rewards and risks. It requires timing, discipline, and a clear understanding of how trades work. So this is not a completely passive approach. It requires involvement. That said, the core idea is worth paying attention to. Markets don't stay concentrated forever. Capital rotates. And when it does, it often creates opportunities in places investors have been ignoring. So instead of asking whether Project 2026 is guaranteed to work, ask a better question. Is the market becoming too concentrated? Because if the answer is yes, then a shift like this is not just possible. It's inevitable at some point, and when that rotation begins, the biggest gains usually don't come from the stocks everyone is already watching. They come from the ones nobody was paying attention to,